Jim, very good having you. Thank you for coming.
Thank you for having me, Neil.
All right, let me get your concern. I understand now that you're worried about what's going on in housing, that this new tax law could come into play in regard to housing. But what's your worry?
Well, first let me preface this by saying, yes, it is still a bull market on Wall Street, and yes, housing is remarkably strong. And that's likely to continue at least through the first half of this year. But we have a problem in that median family home prices have soared over 52% in the past 6 years, and that's raising an affordability problem. At the same time, we're seeing a number of excesses that are carrying those, parallel concerns that we saw back in 2005. They relate primarily to psychology, the risky mortgages, and valuation, all three areas.
So, Jim, I could turn that around and say the appreciable run-up in the last 6 years notwithstanding, if you go back to the meltdown itself, there are many a community that have yet to see a fraction of that gain. So you're worried heated run-up is in the big picture not such a run-up. You say what?
Well, you are correct in that housing is always localized. When you have a boom in housing, it tends to favor certain areas. And those areas tend to carry over into speculation or even fraud. When we talk about housing prices being up 52% in the past 6 years, that's the median family home price nationally. And the problem there is that, once again, that median family home price is 30% above a long-term inflation trend. Now, I think the best-case scenario would be housing prices would level off. But again, that seldom happens. Usually what you see is the speculation and the excesses that we're seeing, both in I would say, both buyers and lenders. You're seeing that psychology, the prices simply can't go down, and that's leading to dangerous overconfidence.
Now, in the tax law, you can't write off as much. In high-tax states, you can barely write off anything when it comes to state, local taxes, that sort of thing. So does that compound the problem for housing?
Well, it dampens buyer enthusiasm, but I think the greater risk right now is the fact that we are in a mature economic cycle. This economy is hitting on all cylinders. We are starting to see those underlying imbalances, rising inflation pressures, that, if anything, the Federal Reserve could be forced to raise interest rates more than the projected 3 times this year.
But they'd still be low, Jim. Rates would still be low. And I know what's been happening. Rates, they have been getting higher. Nothing like what you and I can remember, of course, from years back. But you're arguing that the trend will not be the friend, right?
Well, long-term mortgage rates today, 30-year mortgages rates are just a little over 4%.
Right.
They were 6% in 2007, 2005. No one's asking, are housing prices sustainable or supportable today if we see that mortgage rate just go back up to 5%? At the same time, we're seeing a lot of those high-risk mortgages being made. And Fannie Mae and Freddie Mac, while the perception is they've tightened their lending standards, they also redefined what subprime loans are, from a credit rating of 660 down to 620. And then you have the FHA loans, which allow loans of less than 5% down. They were less than 3% of the new loans back at the peak in 2005.
So you're saying we're getting risky, a little devil may care again. Now, let me turn this around. What people have told me, knowing that you were coming, looking forward to hear that you were going to be here, for good or bad. But one thing they said, Jim, is that maybe housing doesn't lead the economy like it used to. Maybe this concern about housing is overstated because other factors, like the market itself, like corporate earnings, like all this other stuff, is driving this economy in a far greater way and can absorb whatever happens to housing. What do you say?
Well, housing really doesn't lead the economy. In fact, the housing market didn't bottom until 2011.
You're right.
And the recession actually bottomed in 2009.
No, the point is, what their point is housing isn't as big a deal as you make it to be. You say what?
Well, it still really accounts for about 15 to 20% of overall economic growth, not just the housing market, but also all the other different aspects that housing tends to stimulate through the economy. So it is a significant part. It's not going to cause a recession, any downturn by itself. And in fact, it's just the opposite. I think the risk to the housing market, if prices are overinflated or getting overinflated, as we think, is that in an economic slowdown, and if interest rates are a half or a full percentage point higher than they are today, then those housing prices could come down a notch or two, and possibly more if we go into an actual recession.
All right. What are the odds of that, and what are the odds this market can sustain itself the way it has been of late?
Well, we are in one of the longest economic recoveries in U.S. history. It's the third longest after the 90s and after the 60s. So this economic recovery is no spring chicken. We haven't repealed the economic laws. We haven't repealed recession. So I think it's pretty much a certainty at some point, at least within the next 2 to 4 years, we have to look at the prospect of a recession. And a lot of that's going to depend on interest rates and if those underlying pressures force the Federal Reserve to bring rates up faster than what everyone anticipates.
Well, let's say the Federal Reserve does raise rates faster than normally. You can look at that. They're doing so for a reason. Economic activity is picking up. You're seeing all these companies and what they're doing, what they're forecasting. You're seeing what the IMF is saying about global growth as a result of the tax cuts in this country, the hacking of regulations in this country. What do you think of that?
Well, when you step back to past cyclical peaks in the economy, whether it's 2007, 1999, or even 1987, leading up in the months before the 87 crash.
Right.
Basically the confidence is very, very high before those periods. I think we have to keep in mind that, particularly when it relates to the stock market, and the stock market does lead the economy, markets peak when the skies are bluest, when there is not a single cloud on the horizon.
Are they at their peak
and we actually
right now?
have
Do you
one
think
of the bluest
they're
skies
at their
today.
peak right now?
I don't think so. I think we can still continue into the first half of this year, but I'm going to be surprised if we don't start seeing some warning flags appear by the middle of the year.
And then what?
Well, then we have the prospect or growing possibility that the economy could, slow down and actually fall into a recession. And I'm not going to stand here and say that we are going into a recession. We are still almost 80% invested, in the market. But for the first time in over 2 years, we reduced our allocation last week from 83% down to 78%. I think this is a time.
Where's that other money? Just in cash, bonds, both? What?
Basically earning safe short-term yields.
Okay.
It's a time to step safely and carry a comfortable cash reserve that allows you to sleep at night.
Jim Stack, thank you. I wanted people to hear what you had to say. I wanted to balance out between the froth and some of the nightmare scenarios. I think you provided a good balance of that. I want to thank you, James, very, very much.